one thing I will say is, given the massive amount of innovation taking place right now, that is going to be highly disruptive, we do not believe that most asset allocators have enough allocated to innovation. And I think that the traditional benchmarks talk about risk because of these innovation platforms: DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technologies. Because those are going to rip through the traditional world order and disturb it mightily, that those benchmarks are probably where we're seeing the bubble today. I know what I find so interesting about movements in the market today is the fear of interest rates and inflation picking up really started in February of this year as people were getting vaccinated. And the markets went after our strategy to express the risk and basically shorted our strategy. What I find so interesting about this is that the market's multiple, broad-based market, so S&P's multiple on next year's earnings is at 24 times. NASDAQ's is at 31 times. These are near record highs, except for the tech and telecom bubble. If inflation is really the risk out there, why isn't the entire market's multiple coming down? I remember when I started in the business, late 70s, early 80s, Art introducing me to Capital Group on the West Coast, and I'll be forever grateful. Back then, I think by the end of the bear market in 1982, the market's multiple was down to 6. I just mentioned that we're up to 24 on that basis right now. Now, you're going after multiples in our space, and what has happened, the depreciation in our stocks from mid-February to today has not done anything to our forecast. We're now just getting our forecast. We're now just getting our companies and our stocks at lower prices. So in mid-February this year, as we did our 5-year forecast, and we assume massive multiple compression during the next 5 years to something like FANG multiples, EV to EBITDA in the 18 to 20 range. When we did that in February, at the peak of our strategy, the compound annual rate of return we expected from our portfolios was roughly 15%. Today, doing that analysis, some of our projections have increased. The compound annual rate of return we are expecting is close to 40%. So in February, we were expecting a doubling over 5 years. Today, we're expecting nearly a quintupling over 5 years. So I think the platform that has been hit the hardest in this correction is the genomic revolution. And the reason is many of these companies are losing money. We're in this is a movement in its infancy. And I think the most exciting thing is we can now isolate mutations in and among our 6 billion bits of code in our genome. So 3 billion base pairs, 6 billion bits of code. Until recently, we could not isolate those mutations. Mutations are the earliest manifestation of disease. And now what we're beginning to understand is the convergence between and among DNA sequencing, artificial intelligence, and CRISPR gene editing, as well as other gene therapies, is curing disease. We have functional cures now for beta thalassemia, sickle cell disease, ATTR. Now, these are blood-related diseases, but the companies involved are now focusing on some of the most complicated diseases like diabetes. And what we're learning from companies like Freenome, which is a private company focused on the convergence of AI and DNA sequencing, we're learning that the body sets up for disease, and that artificial intelligence is able to discern when that setup is taking place. So wouldn't it be wonderful to discover cancer in phase 1 or stage 1, or maybe even before it starts, before the cells start replicating? So The genomic revolution fund that we run has been hit very, very hard this year. Now, it had a magnificent last year, up 180%. I think it's down 35% this year. We're probably more excited about that opportunity in terms of how it's going to transform lives.
What's going on is tax loss selling. That's just a technical factor. Beyond that, I think that the fear of inflation and interest rates rising, especially after Chairman Powell declared that perhaps inflation is not transitory here, has scared the financial markets. This really started in mid-February, this correction. So this is a very long correction for us. We actually think the bigger risk is deflation by far. I disagree with Barry completely on this, and I look at these rent increases as major tax increases effectively on the lower income earners, and the same thing with gasoline prices. The University of Michigan Consumer Sentiment Index is lower now than it was at the depths of the coronavirus. Why? Because purchasing power is diminishing here so much. I also think that businesses that have spent the last year and a half scrambling to catch up with consumption, they were way behind, are now overdoing it. And we are in the middle of a major inventory build that is going to unwind next year. So that will be a cyclical deflation. And then innovation itself is inherently deflationary. We're seeing, just to give one example, artificial intelligence training costs dropping 60% per year, right? And AI is going to permeate every sector, every industry, every company. It's going to become, very competitive. So we think, and that's just symptomatic. There are so many other deflationary forces out there associated with DNA sequencing, robotics, energy storage, blockchain technology. So, and what we're also seeing is the convergence between and among these various innovation platforms, so that one S-curve is going to feed another and another. And so people are saying, well, then why are these stocks going down? The question we used to get is, we're in a bubble, aren't we? I said, we're not in a bubble. And now that our stocks are down, but the averages are up, many people are thinking we're in a bubble still. And we are, and it's called the benchmark stocks, which are going to be disrupted as the traditional world order is disintermediated and in often cases is going to be destroyed by this new world. So you can say I'm talking my book, but those are two massive secular deflationary forces. One is extremely positive. Deflation, learning curves, cost declines, price declines in innovation means we'll get a boom in innovation. The other side of that is there are many companies who, especially since the tech and telecom bust, and then again 08, 09, they've catered to short-term oriented shareholders who are scared. They've been scared ever since 08, 09, and they want their profits now, they want their dividends now. So these companies leveraged up, buy back shares, manufacture earnings, and didn't invest enough in innovation. They're going to face a lot of problems, and they will face the bad kind of deflation.